Welcome back to the anti-bubble report, and we're going to move on to a very important section, which is going to discuss China. For me, Lehman squared. And it's a very important and complex issue. So we're going to go in some degree of detail. And let's start with the big picture analysis. And I broke down the discussion in several parts. I'm going to go and discuss them in detail on a one by one. Let's start with central bank planning. And with that, I think before we move there, I think this idea that whilst China is trying to make changes to their model, they also, every time they're in trouble, they always do the same, which is, if in trouble, they go to the formula, which is print, lend, spend, subsidize, guarantee, bailout. I mean, this is always the same issue. And I think China is, in my opinion, a time bomb. Let's start with perhaps these structural issues, and central bank planning, I think, is a bit of a double-edged sword. You have things that have been on for a long time, such as the one-child policy and the implications on demographics. We have currency controls and what it means for the yuan, and this trade-off between volatility, stability, and severe macro imbalances. We have this central planned growth targets that if you don't meet, we're going to have a problem which can create significant misallocation of capital. We have the creation of a shadow banking, which is the emergence of unregulated credit and lending when monetary and credit policies have been effectively run differently through other parts of the world. And so you have this tremendous unregulated market, which is very difficult because it means that there's no stress test. We don't really know how big it is. We can estimate it. But this is, to me, this obsession of control and rigidity is actually fragility during times of crisis. The second point I want to make is, I call it China's wars, but basically many fronts that are open that lead to, that you need to prioritize. And obviously there are trade wars, which have been taking for a long time, with subsidies, with dumping, with tariffs. You're trying to create, economic activity, growth, employment, and you do it at the expense of other things. And that's created tensions with many parts of the world. You have currency wars, which I think are clear, and the peg to the dollar for a long time have a severe impact in places like Europe and others. Again, you're trying to trade off here between short-term, long-term, between jobs, exports, inflation, etc., which I think it's coming to bite them. Quietly, but somewhat interestingly, they are also positioning for reserve currency status, which is aspirational, I think, alongside with others, but it has created this very positive carry trade, with high interest rates, and the perception of stability has attracted a lot of money into 10-year government bonds at 3%. I just call for caution because this is going to be a carry. I think it has the potential to unwind aggressively if volatility picks up. Not to mention geopolitical issues with Hong Kong, Taiwan, South China Sea. This is obviously a major concern for all of us. Wars on technology, where China obviously is trying to control people, and I think technology is a big threat. So China's big brother is today more real than ever, and the situation with COVID has, in fact, exacerbated the situation. And culturally, and I think we cannot underestimate this, the cultural wars with Xi taking a turn and on capitalism with their view on modern socialism, and the war on billionaires. He didn't hesitate to take down Jack Ma or others as he positions himself and his culture, which is now being taught at schools. So a lot of maniac type of behavior, which is worrisome. In that sense, we see some of this is led to, here what we see is the divergence at the top between the S&P and Hang Seng, and then at the bottom, technology in the US and China. Pretty interesting, obviously highly correlated during normal market conditions, but we've seen a pretty brutal divergence, and this is due to push-pull effects, both the US sort of fighting and prohibiting stuff, as well as Xi and others. So an opportunity perhaps, but clearly showing that China has different priorities, and billionaires is not one, and they'd rather have control over these firms than big market caps. They want the product, not necessarily the valuation, at least for now. The other interesting thing, in my opinion, is these bubbles they've created, this degree of freedom as you print and constrain the system, which are pretty much everywhere. Credit, we've been subsidizing growth and capacity, zombie industries, a lot of infrastructure with roundabouts and whatever you want to, just to make sure those numbers were built. And obviously, and most, perhaps very, very importantly, real estate, which is estimated to be about 30% of China's GDP, and goes hand in hand with shadow banking and other ways of investing and wealth management products, and a lot of things that altogether come from these macro imbalances. The onshore offshore dynamics, which don't get me started. I think there's a lot of issues and potentially a lot of fraud taking place. And so I think in that sense, this leads us to one of the key catalysts, which is real estate. And I've compared Evergrande. People talked about Lehman. I don't think it's a Lehman moment. I think it's a Bernsteins, which those of you who remember was a precursor, not a huge event at the time, but we could all connect the dots looking back. And I think this is something that is third largest potentially bankruptcy in history. It can create, and it's already doing, a domino effect in real estate and beyond. And this is an updated overview of what's been happening in the sector and what it means, and something that is definitely going to have an impact directly and indirectly to many sectors. In fact, this contagion, I think, is critical. The domino effect within real estate and construction, and what it means for China, what it means for the financial sector, for the banks, what it means, that this is more new, the impact for investment grades. So even as things start to happen in junk and high yield, contagion spreads on, and it would be naive to think that this is going to be a China only issue. We talked about wealth management products and how the government will definitely try to protect retail. Clearly, the billionaires are going to be paying for some of this with their own stuff, so there's no corporate shield. They're going to go for the personal wealth for sure, and we'll see what it means for many sectors, whether it's those that are relying on China as a consumer or as a supplier, and what it means as all these things play out. But I think this is hugely important, and I think ultimately, the deleveraging of China will impact global growth. It will obviously impact Chinese demand. According to The Guardian, as I show here, the real estate sector is estimated to be at 55 trillion, which is twice the US or 4 times the GDP. So these are bubbles, without precedent, in my opinion, and super worrying. And ultimately, I think this leads to the degree of freedom of the system, which is the currency. The yuan, I think the devaluation, even if the consensus is that it's a fantastic currency, I continue to believe it's a matter of when, not if, that we'll see a meaningful devaluation. And we talked earlier about energy as a potential catalyst. I think this real estate is another, and it's really a major situation. So this can be exacerbated by the fact that, as I mentioned earlier, this has been a positive carry trade that attracted a lot of capital, the tail risk of inflation, and ultimately the end game, I think, for China, which is stagflation. So the levels of growth driven by debt are unsustainable, and ultimately this gross misallocation of capital is coming to haunt them. I think very importantly, this is a tweet that happened a while ago, and it talked about the PBOC injecting $7 billion into the banks, and my response was no, they didn't. They injected 50 billion yuan, and it's a big difference, because obviously the central bank can print yuan, they cannot print dollars. And this is the reason why this situation is more delicate, and I think it will eventually 2 + 2 will equal 4, and I think that means the yuan could go significantly lower. I hope this part was helpful. I will continue in the next video with the central bank trap, talking about the difficult balance for central banks between inflation and bubbles too big to fail. And once again, thank you for your time, and speak soon. Take care.